Hello and welcome to another Algo IQ tutorial presented by Halifax, America. Our topic today will be a common performance stat known as profit factor. What exactly is profit factor and why is it so important? Profit factor is simply the gross profits divided by gross losses over an entire trading period. It's also important to note that profit factor typically includes commissions and fees in its calculation. Now, why is a profit factor so important? Simply put, it's a metric that can help you analyze the degree to which profits are greater than the losses. Let's take a look at a hypothetical example. For instance, let's say a system over a 12-month period produced the following results. Its gross profits were $50,140. Its gross losses amounted to $34,200. Simply divide the profits by the losses and you come up with a factor of 1.46. That means 1.46 units of profit for every 1 unit of loss. It's a positive profit factor, indicating that it's a potentially profitable system. Now let's suppose that the system had lost more than it had made. For instance, let's imagine that the losses were $50,500. In this case, the profit factor would be below 1, specifically 0.99, which indicates a losing strategy. Now, having said this, and as you analyze different systems or strategies, it would be appropriate to mention the difference between hypothetical versus live results, both of which have pros and cons, and we encourage you to watch our video on the differences between the two, as the comparison is not as simple as you might think. Let's now go to our Algo IQ page and take a look at a real system. Notice the rows and columns toward the bottom of the image. The profit factor can be found 3 rows down from the leftmost column. In this case, the profit factor is positive, it's 1.12. which takes into account gross profits and losses, including commissions and fees. You can also view the average profits and losses on the same row, and out of curiosity, if you were to divide the average profits by average losses, which is a slight variation on the profit factor as you're taking into account average versus gross profits and losses, your average profit factor would amount to 1.14, which is slightly higher than its traditional calculation. To recap, profit factor is defined as the gross profits divided by gross losses over a period of trading activity. Its importance is that it can help you analyze the degree to which profits are greater than losses. A profit factor above 1 indicates a potentially profitable strategy, while a profit factor below 1 indicates a potentially losing strategy. Now, one of the examples we cited is from our Algo IQ page, which is a list of algorithmic strategies you can choose from and potentially subscribe to. So it's therefore important for us to include a risk disclosure. It's important to know, for instance, that past performance doesn't always guarantee future results, and that some of the systems listed have hypothetical and live results, and it's important for you to know the limits, the inherent limitations in hypothetical performance. You can also see our video, which compares hypothetical versus live performance and explores the pros and cons between the two types of results. If you have any questions about this presentation or about Algo IQ or Halifax America, feel free to send us an email at team@halifaxamerica.com. You can also visit our website at halifaxamerica.com. Thanks for viewing our video. We'll be back with more tutorials on metrics that can help you better evaluate trading performance.